Hello, and welcome to Never a Dull Moment, a talk show and podcast for angels and founders. Ziad of Boston Harbor Angels has fun with co-hosts and guests as they discuss and debate all topics from the world of startups and entrepreneurship. Welcome to the conversation.
So happy
now,
to have you.
Here they are. Enjoy the show.
Let me jump into my question that I've been burning to ask you. So if someone's talking to you, a founder, a startup founder, or a business owner, is this good news? If they're actually talking to you and there is work being done, is that good news for them?
Well, I certainly think so, because one of the hardest things that a founder will ever do is eventually get to some kind of a liquidity event. That's a really tough situation. And if they're starting to think about it and plan for that, that's probably the most intelligent thing that they can do in terms of being able to set themselves up to get to that liquidity event.
So if they're talking to you, basically, now we're setting the stage, is because you're helping them with their liquidity event that comes in multiple ways. You specialize in everything that's not going public, right?
Well, a little bit tighter than that, actually. We do not get involved with venture capital or minority investments. We specialize in majority recaps and outright sale of the company.
Okay. So So the second burning question is, when should someone start thinking of selling their business? You know, if they could own it 100%, which we call a lifestyle business, or they could have a bunch of investors like us, Boston Harbor Angels, whatever. At some point, they start thinking, okay, I have to prepare to exit, to sell, to have a liquidity event. When should that be?
Well, it really needs to start as early as possible in the journey of developing your company, because when you think about it, things like structuring contracts, employment agreements, making sure that you have your board minutes lined up and all of your documentation around formation of the company, all of these things are going to be necessary when you get to the point where you are going to enter discussions with a potential acquirer or a source of capital. So you need to really structure the business in a way that you don't have to change when you start those conversations later on in your business life, especially things like contracts, employment agreements, making sure that your intellectual property is well protected, and also in terms of your financials. If you can structure your financial setup in a way that maps to a similar company that's in a public sector, so that a buyer will readily understand the structure of your financials, that is a great asset when you're talking to those buyers, and will enable the sale to happen a lot easier. So, and you don't want to have multiple changes in how you're structuring your books as you go through your business career. So you need to set up those books early to map to the public companies that are in your space.
So, okay, this is fascinating. So technically you should start preparing to sell the business the day you start it.
That's right, yeah.
By having clean books, by keeping good records, by having all your legal documents all done right, by basically thinking that at any moment someone could come and do due diligence on you, and they're not going to find any red flags that they might turn away, right? I mean, this is the big due diligence. When you're ready to sell, they say, okay, open up. And you should not be afraid of doing that.
That's absolutely correct. But, I mean, there are certain sets of circumstances that do crop up that are not great news for a buyer. Those sorts of things, maybe it's a lawsuit or maybe it's some kind of staff disagreement. Those things happen, and buyers understand that. And you just need to make sure that when you do get in a conversation with a buyer, that you bring those things up early to develop a trusting relationship with the buyer. But, those things do happen. So you're never going to have a completely clean set of circumstances to put in front of a buyer. Maybe you do, but it's uncommon. But when you do have those sorts of circumstances, you want to bring up any troubling things early in the process.
You don't want the buyer to discover them.
That's right.
We do the same with investment. We say, look, just don't let us find something you're trying to hide, or that sends such a bad message of trust, right? It's a how much emotions, trust, psychology is involved in the buying process, as in parallel to financials and all that stuff.
Well, look, the ultimate situation when you're contemplating the sale of your business and you start talking to potential buyers, the way that you optimize your exit is by speaking to multiple buyers and building a competitive environment, that tension between the buyers, because you really don't want to have your valuation established purely on your financial history. You want to make sure that you're telling the story about your business that has the buyer looking through the windshield, not in the rearview mirror, right? Because that's where the value comes from. Every buyer is going to look at your business in a different manner. All the intangibles are going to be assessed based on their strategic thought process and what they can do with the business after acquisition. So multiple parties coming to the table will have different valuations for your business.
Okay, I like that. It's looking forward. So they're buying not for what you've done, but for what you could do in the future.
Yeah. Now, of course, they're reluctant to pay for that.
Yeah.
Right?
Yeah.
They want to pay for what you've done, not for what they bring to the table. And that's the key. The key is to have a competitive process where multiple parties are bidding for the same property. And that way you can start absorbing some of that strategic foreground that you see out of the windshield as part of the enterprise value of the sale of the company.
Okay, that's excellent. And so as a business owner or a startup founder, ultimately you need to understand the parameters that those people are going to look at, like what's important to them and what are the matrices that are important, what unit measures they look at, revenue, profits, the customers, growth, regional growth, right? Those are important.
Correct. Absolutely. Especially in the world of software SaaS companies, there's a set defined mechanism and measurements and KPIs. You're going to have to, if you are a SaaS company, you are going to be asked for buyers to produce something that looks like a revenue by customer, by month, by product for the last 3 years. Because every buyer has their own way of calculating churn. And the only way they can really get that data is by having those kinds of complex views on your revenue stream that they will come through and really get to the metrics in the manner that they see fit. And
you need to understand your own business. I mean, it's astonishing how and it's hard. I mean, we're entrepreneurs, founders. It's not hard. It's not easy. They need to raise money and run the business and deal with customers. And sometimes some things fall by the wayside where they don't understand their own business as much as they should. And someone like you could help them. You spend a lot of time pre-buyers, right? Just to help them understand their own business, getting it ready, get things lined up, and wherever there are holes, you say, okay, well, go get that information.
Absolutely correct. We work with a lot of companies, in the $1 to $2 million, sometimes even earlier than that revenue range, setting themselves up. We'll work with them for 2, 3, 4 years before they're ready to hit the market. One of the biggest things that we see as problematic is this whole notion of revenue. When you think about revenue, if you're doing SaaS, that's recurring revenue is the most valuable form of revenue in the eyes of a buyer. Obviously, the predictability and the low risk of that revenue creates a higher valuation versus something like consulting or one-time development or training. Those kinds of revenue streams are much less valuable. So you want to make sure as a founder you're separating out the revenue streams and can keep track of them, because buyers are going to be interested in the more valuable ones. And if you don't separate them out, they're going to apply an aggregate multiple to your revenue stream. Whereas if you do separate them out and most of your revenue is recurring, you're going to end up with a higher valuation. So having those tracking mechanisms in place early in the business so that you can keep track of the individual revenue streams. Maybe it's by product, maybe it's by service or software, whatever it might be. Keep those separated out so that you can track them.
And if you don't have recurring revenue, get some.
Get some. Exactly right. Yeah. I mean, recurring revenue is 3 to 8 times more valuable than one-time revenue. Okay,
all right. And track record. So what's recurring revenue? How do you prove it's recurring? Like, do you need it? You said 3-year track record. Is that enough to show that it's been recurring?
Obviously, the first thing is, what's the length of contract with your customers? You might have a 5-year contract or a 3-year contract that's paid annually in advance. Those sorts of things are valuable to a buyer.
And contracts. So the important part is, if you have recurring revenue that's not under contract, does that count?
Oh, it does. Absolutely. But obviously, if it is contracted, there's a little less risk involved in the downstream years. But certainly, if you have a track record, so a client might have been producing recurring revenue for a number of years and you don't expect them to go away, if you can prove that through past billings, then you're in good shape. And that's where I say, this by product, by month, by customer for the last 3 years is an important piece of information to have.
So if I go eat brunch at the same restaurant every Sunday, am I recurring revenue to them?
In a way, yes, but
I could switch.
The stickiness isn't there, right? Unless you happen to really have a bent for that particular type of food, right? It's the stickiness. That really counts. So having an application that people depend on, that is mission critical, is also very important in that whole. Making sure that your churn rate or customer retention rate or net revenue retention rates are where they should be with respect to buyers.
And then your customers, if their data is on your app, we're talking about SaaS, that's also a barrier to leaving you. Like they're not going to pick up their stuff and leave.
That's right.
And so give us some numbers on. I know once we spoke about the average number of years for a business to sell. Can you give us some insight on market data that you see around?
Yeah, I mean, we track this on a monthly basis with our own podcast web seminar every month, and I think the last month, the average length of time that a business has been in existence before selling was 17 years. Okay, now, that's specific to tech, right? All we do is tech and tech-enabled services companies, sell-side engagements. That's all we do. So,
but that's owned by. Does that count startups and lifestyle businesses and single owner businesses? So that's combined, right?
Yeah, I mean, we get essentially, there's 3 kinds of companies that we see a lot. The first is when somebody has reached their retirement age and they don't have a successor for their business. So they're trying to figure out what's the next step, right? The other kind is when a founder is a deep technologist, but is not a sales and marketing expert. So the sales have gone up and then plateaued as they get to the point where they're really not well versed in growing the company from 5 to 50 million. So those kinds of people need help with sales and marketing and need to be in somebody else's hands to make that business really fly. And the third kind are the guys that are debating whether to take a venture round or sell the company because it's growing really fast and they feel like they've got a bull by the horns, but they're not sure how to control it. So those are really the three.
And how do you deal with governance? So if it's a sole proprietor or a business owner that controls everything, they just you work with them and they say, okay, I found an offer I like, thank you, you're on. Then you have to deal with accounting and taxes and other things. But what if there is a board where there's not a single group that has a majority? So there's a VC on the board, there are other things. Does that add complexity?
Well, it does add complexity, but it's really part of the preparation for going to market, for taking your company out for sale. In terms of making sure that everybody is aligned with what the outcome needs to be to get everybody happy, right? So those discussions need to take place in the preparation phase so that everybody understands the parameters, they understand why you're doing it, and they understand what constitutes a successful outcome. We find we have experienced greed coming in, right? So we get expectations set. Okay, look, if we get a $20 million offer, we're great. We'll be okay with that. So we go out, we find them a $20 million offer. In fact, $25 million offer in one case. And we take it back and they say, I wonder if we could get 27. So we go back and we renegotiate the LOI, and sure enough, we get 27. And then they come back and say, gee, 27, that sounds great. Maybe we can get 35. And eventually you get to the point where the buyer says, you know what, enough, I'm done, I'm out.
And they're out. It's not that they go back to the earlier offer. They're out completely.
They're out because they don't necessarily want to work with that. You've actually ruined the reputation and the relationship with the buyer at that point. Just need to be very careful of that.
Agreed. And I read an article about also hubris, and we've all been burnt by situations where someone was arrogant or greedy, or so how long does it take to exit? We have a lot of companies that come and they say, well, we're in great shape and Google will buy us in a year or in 2 years, or we're in talks with some strategic partner and they could be a good buyer. And then the reaction is always, well, have you started negotiations? So in your experience, let's say the company is doing well and then someone starts talking to them now about, or they engage you and say, okay, we want to sell. Mm-hmm. From that minute to the minute they sell, how much do you estimate it takes?
I'd say on average, it's about a 9-month process. Generally between 6 to 12 months. We've had clients. I sold a company last year where they, from start to finish, from the day they signed our contract to the time they signed the sale documents, was 4.5 months. That's short, but not typical. We have also had clients where we've gotten into a situation where the offers that came in, or there weren't any offers, but the offers that did come in were not where they wanted to be. So, but during the process, you learn a lot about your company, right? First off, you're going to look at your company in a different light. You're going to look at it from an outsider's point of view. And you're also going to be talking to people who are looking at your business and giving you opinions about what they value and what they don't value. You might also engage with many companies who are not necessarily buyers, but might be really good commercial partners for distribution or whatever that you can take advantage of. So there's a number of different things that come out of working the process that you can build back into your business. So in some cases, you don't want to sell immediately. You take those lessons that you've learned from the market, build the company in a manner that is more applicable to the community of buyers that you're going to approach, and then go back out again. We've done this a number of times. We have a hiatus program that we put our clients through if they get into that situation. Sometimes they'll go through it 3 or 4 times before they get sold. We had one company that sold after 7 years, after 3 different attempts at going to market, but they got a great exit at the end of it.
And it's not done until it's done. Like until the deal is closed, everything could still go wrong.
Absolutely. I mean, this is an emotional roller coaster for the CEO of the companies. Especially when you get into due diligence, when everybody is calling your business ugly and you're waiting for a retrade and the market is, there's something going on in the market, or you're waiting for somebody to push a button to launch a missile in, some other country. There's all sorts of things that can go wrong. Due diligence is where deals go to die if you're not careful. You need to be very careful about preparing for it and making sure that you spend as little possible time in due diligence as you can. But it's an emotional nightmare. And
that's why if you prepare, like I know in the world of angel investing, founders who are prepared, who have a deal room that has everything, they don't have to go find something. All the questions, the answers are right there. And it's not at the end of the day rocket science, right? Like everybody knows what you need: legal, finance, IP. So preparing is something that is not that complicated, but yet oftentimes people don't do it.
It's only complicated if you're scrambling around trying to get stuff done at the last minute, right? If you don't have board minutes because you forgot to record them over the last 3 years, and now you've got your attorney trying to generate board minutes from the last 3 years, or you're looking for customer contracts that, you've got one, but it's only got one signature on it. Now I have to go back to the customer to get the signature. Those kinds of things can be just a nightmare in due diligence. And it really creates an air of distrust in the eyes of the buyer. And that's what you've got to be really careful of.
Yeah.
Plus, it extends due diligence, which is not a good time for.
And then you send the message that you're not highly organized.
Exactly.
You don't have things lined up. And so what are things you don't like? Or I know you guys deal with tech, so I'm assuming you don't do biotech and other things. But are there deals that don't work for you, or what setup, like too small, too large? What are the things you try to avoid?
Well, there's certain sets of circumstances that we find business owners lead themselves into that are suboptimal for buyers. So first is having customer concentrations, right? So having one large customer and 80 small customers, the risk of losing that one big customer and destroying your revenue stream in the eyes of a buyer is high, right? So that's one thing. The second thing that we try to sort of steer people away from is basing your pricing on a per unit basis that's related to hardware. So think about, for instance, an IoT company, right, that sells based on the number of edge sensors that they sell. The buyer is going to look at that and they're going to say, so this is all one-time revenue and it's hardware based. So, make sure that you have something that has a decent gross margin. And again, that has a recurring revenue stream. That's a much better way to take it on.
Okay. And another thing that is interesting, because what's hot, the trends. So for us, when we invest, whatever is hot right now in terms of the acquisition world is not necessarily interesting, because the company is going to need at least 5 to 7 years to grow and develop. So if AI is hot today, that doesn't mean it's going to be hot in 7 years. Mm-hmm. So how do you see trends? Because I know once I saw you guys published a paper on different trends that are hot for M&A. It was fantastic. Where do trends fall in your world?
So every year, Corum produces our top 10 trends that are driving tech mergers and acquisitions. This is not the Gartner report for CTOs of, what's the greatest thing that you can do to help your business productivity. This is what are the imperatives that are driving change in the world of technology today. And if you position your company in relation to those top 10 trends, buyers are going to pay attention. And that's really the key. Buyers are busy, right? I was talking to a head of M&A for a large public company about 5 weeks ago. And he was telling me that he had 127 opportunities on his desk that had come in that week.
Oof.
Right? So it's imperative when you're talking to these guys that you have that armor-piercing soundbite that gets their intention right up front, because otherwise you're just going to go straight into the discarded section of the email, and you'll never get any time on their calendar. But it's so aligning yourself with these top 10 trends are really the key to getting that attention. We run a seminar called Emerge Briefing that goes through all of those top 10 trends, if anybody's interested.
So are you saying that, well, if you're a brand new company, there's nothing you can align yourself with because you're still too early, you're figuring things out. You're saying if you're 5 years into it and the hot thing is AI, and you have AI in your business, but you never mention it to anybody, and now you should brand it a bit more. Is this one of the things one can do?
Yeah. So telling your story in relation to, it's not a question of changing your business model. It's how you tell the strategic story to the buyer that needs to relate to those top 10 trends. Now, the other thing that you can do is take a look at the past year's top 10 trends, and you can see that there's certain sets of resiliency as it runs through there. So things like focused IT services, right? So IT services companies that have specific expertise in an arena. Maybe it's a vertical, maybe it's Salesforce expertise, or whatever it might be, but it's got to be focused. That's a good place to be. The healthcare continuum, right? Anything that involves how did the guy put it? From twinkle to wrinkle.
Okay, that's a good one. I'll get to keep that one. Yeah.
Yeah. So the whole healthcare continuum is something that if you're involved in that in that sort of development world, that's a good place to be. Composite commerce is something that is that's really come out over the last 3 or 4 years, but it's going to last for a while.
How long does a trend last? Like if someone says, "Oh, today AI or robotics is hot," in general, this is not like a yearly thing. I mean, there is the buzz around blockchain or whatever, but a real trend lasts, in your opinion, how long, if you were to guess?
I would say probably 5 years, maybe longer. Things like, if you think about one of the big trends right now is blue collar software, right? So people being able to be knowledge workers that were never knowledge workers before. And a lot of that stems from edge devices like cell phones and Wi-Fi networks and, things that just weren't there 10 years ago or weren't prolific 10 years ago. That's a trend that's going to continue because data coming in from the edge and going back out again to the edge is extremely important. So, that's a trend that's going to last for another.
What's the earliest you got involved in a business?
Oh, I've worked with founders that are working on their initial business plan.
Really? It's like that's excellent. So it's like saying, I don't know, you're building a house, you just have the land and the architect, and you already have the real estate agent to sell it.
Yeah. Well,
Okay.
we're at Corum, all the deal guys are ex-tech CEOs that have run their own businesses and sold them before moving into investment banking. So we've kind of been through the process ourselves and learned a lot of lessons. You can still see the scars on my back.
And then you also probably love it. Like there's a passion piece, because if you ran a business, you sold it, you know how it's done, and you want to help. So let's a little technical question that has been bothering me for years. What's the difference between a business broker and an investment banker?
Nomenclature?
Yeah, okay. So it's the same.
Well, I think an investment banker is probably a wider description. An investment banker might be somebody who is looking at more of IPOs and raising capital, those sorts of things that a business broker won't necessarily be involved in.
So a business broker oftentimes are smaller businesses that are straight up sale. There's no investment involved in the sale. Like you don't need investors and things like that. Yeah. Wow. Martin, I could talk to you for hours, and I hope you join us again to discuss this topic, because it's really, really important. I mean, we're Boston Harbor Angels. We're in the world of angel investing, so we want an exit at the end, so money can circulate and gets invested again in great founders. And we always need for us to understand, and also for the founders to understand, what is an exit? Sometimes they underestimate how complicated, how important, how stressful, all that. So can you, we didn't do an introduction. So can you tell us who you are and what you do?
Yeah, sure. Martin Lowrie here. I'm with the Corum Group. We are a investment banking company that deals purely with selling technology and technology-enabled services companies. We've been around for 36 years and have done nearly 500 transactions. We did 39 transactions last year. We've got a record number of clients in letter of intent right now. So anybody that tells me that this is not an active market and that M&A is dead, come and talk to me, because this is not the case.
That's excellent.
It might be dead in the IPO market and for the billion-dollar deals, but sub $200 million enterprise value companies are seeing a very, very high level of interest from buyers. There is a ton of money out there. It's an estimated $3.5 trillion in the hands of private equity companies right now that are behaving in very, very strategic manners to build up their portfolio companies through acquisition. And that is what we're seeing a lot of activity around in our business at Corum. If you're interested in seeing anything more about Corum, please come to our events section, corumgroup.com/events, and jump in on one of our sessions. We educate about 10,000 tech CEOs every year coming through our events.
It's so important to understand where you're going to end up early on, as early as you can, understand the exit path. We love it as investors. And thank you again. And thank you for ending it on a positive note in these conditions. And people don't realize there's a lot of activity happens. It's not the big news and the big drama that is prevalent everywhere. Okay, thank you very much, Martin.
Thanks, Z.
Thank you for listening to Never a Dull Moment. We hope you've enjoyed the show. And don't forget to rate and review us. Until next time, have a great day.